they're suggesting it's possible they'll reach that nameplate kind of haulage rate while half the road is still being repaired, which would be a tremendous feat if truly achievable.
All right, money miners, Mr. Ricardinho. We are in the thick of quarterly season, and we picked out a couple stories to chat about. MinRes and Emerald, amongst a sort of flurry of announcements. I saw Northern Star was getting a bit of a boot in after they had to revise their guidance and a few other ones, but we've picked a couple goodies in MinRes and Emerald, I reckon.
Pick the two stories you're keen to tell the most amongst them. Don't you find like when the month of April ends, like because you had 3 public holidays in short order chewing up all this time, everyone just all released their operational quarterly at the same time. I'd hate to be an analyst that actually had to write research reports and update my model and get all of that out today because
it'd be a stinker, yeah.
You covered a few. You'd be under the pump today and tomorrow, I imagine.
Plenty of calls as we are in the second last day, but it is what it is, mate.
Speaking of plenty of calls, mate, you know who would be getting plenty of calls right now, especially as the gold price is going up and people are spending money on exploration. Once again, looking for gold. Who are they calling?
K-Drill.
100%, mate. They are an experienced specialist team. Would you believe 90 years of combined field experience? Now, that is not one individual person with 90 years. There's no 90-year-olds on that team. You know, the 90-year-olds get to retire. But 90 years combined field experience, mate. Unbelievable.
Mate, when you're an exploration company or you're a miner and the lifeblood of your business is finding gold, finding lithium, finding copper, whatever it might be, you want to go with the experienced team, don't you?
You want experienced team. You want people that know how to use their rigs and get the most out of them. We're talking about RC and diamond drilling in their blood. This is specific expertise that it traverses geographies and geology. It is. They are capable in challenging terrains all across Western Australia. And when you get in touch with K-Drill, mate, you deal directly with people who have the field credibility, not layers of admin. They get stuff done. They're approachable. They're pragmatic. And when conditions get tough, guess what? That experience matters because these are people that can be very resilient and operate when things get tricky. There,
safe, reliable, productive drilling. Call K-Drill, the champions in RC and diamond drilling.
The irony of segueing when you say safe, reliable, productive, and now we've got to talk about MinRes.
all right. Let's not get ahead of ourselves. It was an interesting quarterly, and the market is liking it. Let's get into it, mate.
I think they've eased some of the market fears today with the quarterly, and MinRes quarterlies, they always seem to be a pretty interesting day on the market. Lots of other companies reported today, but I had a ton of vision for the MinRes call. And the important thing to mention up front is that the market liked it. The share price is up a giant 15% today in response to the disclosure. And I use the word disclosure unironically for once on MinRes because this quarter actually provided much more granularity on areas of the business that are forefront on the minds of investors. And we have to commend them for doing that up front. Specifically as it relates to the whole road and ramp up of Onslow, we get some really good detail about what they're doing, what their plans are, and how they intend to reach their targets. It's been a tumultuous few weeks just in the lead up to this release, JD. Notably the departure of 3 board members in very quick succession, and also the news about the class action that dropped earlier this month too. But the talking points that come out of the quarterly today and the things I want to touch on in conversation with you are it's all related to the operating health of this business. We're talking the balance sheet, how Onslow's going, how's the haulage ramp up and bottlenecks going given the road repairs there, what's the status of the lithium business and what's happening to the mining services margins.
Yeah, absolutely. And all the sort of tumultuous events that you mentioned there don't even encapsulate what's happened at a broader macro level, which has been particularly wild. As it relates to MinRes, FX has fluctuated pretty wildly, and iron ore steelmaking is a commodities that demand fluctuates with the growth and the GDP of sort of developing nations and countries all around the world. So let's get into it at a micro level now with the balance sheet. That's the first spot that people have always looked or have looked at least for the past couple of years with MinRes.
Yeah, it's no secret that their balance sheet is stretched, and when your balance sheet is stretched, what really matters is what's your quarter on quarter change in cash. And for MinRes, in their March quarter, they ended the quarter with $250 million less cash. So there are some operational wins that they've kind of point to, and they've certainly kind of had in various areas this quarter. But I think the money miners should always just remember to contextualize what could be potentially accounting wins when the business is still losing substantial cash. I think it's always important to kind of keep a questioning eye if your cash is still not moving in the right direction. But if you look at what they've got this $800 million revolving credit facilities undrawn at the quarter end. They've got $450 million of cash and cash equivalents remaining at quarter end. So combine those two, and they point to this $1.25 billion of liquidity. They call their net debt $5.4 billion as at the 31st of March. What that has baked into it, which isn't immediately apparent, is the revaluation on the US denominated like bonds, thanks to a slight FX movement, is $80 million favourable. It's also that 5.4 is also excluding the physical loan or deliveries that they have to do under the prepaid with Traffic Europe too.
Yeah, and what about the sort of levers as it relates to what the company has flexed or spoken about, the potential to flex if things get tighter going down the track?
I thought there was like a noteworthy difference in the way that CFO Mark Wilson discussed this. I'll play a snippet for you guys to evaluate yourself.
And do you have any sort of active testing of the market on the asset sales at the moment? And if you do, how do you actually order those options? How do you think about actually ordering those levers or asset sales?
The way I think about it is this. There's a cost associated with every choice, right? Equity raise, as we keep being encouraged to do so by aspects of the market, that in my mind has a huge cost at today's price, a huge impact on shareholders who don't participate. So I think of that as an extreme high cost alternative. At the other extreme, I've got precedent transactions for the road at over $1 billion for half of it that I know I could transact on if I needed to. Again, I'm not saying it's a priority or a preference, but I'm giving an example. We've talked previously about opportunity to do something with the carry loan, which is sitting at $800 million. So there's a lot of capital tied up in those two assets alone.
So normally when I've heard Mark talk about levers, and it's a common question, but he often mentions the carry loan first. From my memory, I mean, before they sold the gas, he'd mentioned the gas first, and then before they sold the whole road, he mentioned the whole road first. But I always read into a bit the first thing he mentions, and this time around, the first thing he mentioned was the other half of the whole road, selling it for another $1 billion. I mean, that's an intriguing point, and kind of count me doubtful that MinRes would be able to get $1 billion for the other half, but it's surely worth something, and it's interesting that was the first thing that came to his mind and came out of his mouth when he was talking about it. The Australian has also talked about them selling Bald Hill in recent days. I could see that too, and of course, there's genuine potential of a minority sell down in the broader lithium business or discrete mines. That's all of that's impossible, or even a prepay. As it relates to lithium too. The big elephant in the room, and one of the reasons the market has responded the way it has today, I think, is the hardline sort of stance that MinRes has presented in its messaging around equity raising. There's basically, it's like on the front page, no equity raising is being considered. So I think the market reads that, interprets that, and thinks, great, there's no immediate short-term risk of a cap raise, and that explains some short-term price movement sometimes. And then to round out the balance sheet, I do think you've always got to talk about their bonds as well. And historically, MinRes have talked about refinancing their nearer-term maturity bonds. They've got some that mature, I think, in June 2027. They're the earliest ones where the big chunky principal repayment June 2027. Now, the bond market has moved a lot in recent history. Specifically, MinRes's bond markets have been very volatile themselves. Mark Wilson himself kind of spoke to the fact that if they were to refinance the near-term maturity, instead of paying an 8% coupon, which they are at the moment, they'd be looking down the barrel of like a 12% coupon right now. That even though they can refinance as of May, so in just days really, without actually wearing an early cost associated with doing so, he actually played down the potential of refinancing in the near term because I'd rather wait out for that the implied coupon to lower as they ramp up and de-risk. Now, whether that happens or not sort of is all up in the air, but I found that kind of interesting. Don't know what you thought, JD.
Yeah, Yeah, fascinating. I mean, I think we should talk about Onslow and the performance of Onslow, because you can't really talk about the bonds without, discussing the manner in which ramp up is going and the additional colour which they gave specifically on the haul road.
I think this is a big thing to wrap your head around. FY25 guidance has peeled back slightly. March quarter volumes are disappointing, but MinRes has provided great detail on how it is navigating its current haulage constraints. And don't get me wrong, the plan seems pretty ambitious, but the detail is good. And you can see on this map here the haulage route, right? Right now, MinRes is hauling ore from Ken's Bore to port via both its they've got their own big jumbos, the big MinRes jumbos, which can take up to 330 tons, and also some kind of like normal sized road trains, which are largely third-party contractor road trains that they're utilising. Now they're undertaking upgrades on their haul road itself. That was announced earlier in the year. Pretty substantial upgrades going on there. So as they're doing these upgrades on the haul road and asphalting it, etc., the jumbos are actually continuing to use the haul road, while the contractor trucks are running on the parallel access road for the first half of the leg, then on public highways for the second half of the route, like you can see on the yellow line here. MinRes say that the volumes of iron ore being hauled in April in total is 1.3 to 1.4 million tonnes. Now this table I'll flash up here. This table breaks down the trucks, the payloads on the trucks, and the cycles per day of the trucks. It's great granularity of what is being done in April, and that's 1.4 million tonnes per month annualized is just 15 million tonnes per annum. That's a long way from the nameplate of 35 million tonnes per annum that MinRes needs, right? So status quo.
Yeah, 15 to 17-ish
Yeah.
tonnes per annum at that run rate, but they give more detail on the next 2 months.
Exactly. So this is interesting, right? Exact same table, flash it up of what they expect in May to June, the remaining 2 months of the quarter. They say they're going to be able to get 2.7 to 2.9 million tonnes per month in May and June. And 2.9 million tonnes per month annualized is 35 million tonnes per annum. They're suggesting it's possible they'll reach that nameplate kind of haulage rate while half the road is still being repaired, which would be a tremendous feat if truly achievable. And how they're going to do it? Well, you can just interrogate the table. They're doubling the number of contractor trucks while getting 25% more cycles out of the contractor trucks. Plus, they're adding 14 new jumbos of their own while getting 25% more cycles out of their own jumbos, all while keeping the truck payload constant, notably restricting their jumbos to 260 ton payload, not 330 ton.
And they're going to heavily utilise those additional routes, which obviously wasn't previously the plan. But this is one of the points that the market must have really liked, I'd imagine.
Mate, big time. Yeah, and there's even this quote saying the above forecasted cycles per day are currently being achieved. So it's a very ambitious thing to just double the what your haulage bottleneck. You've got a bottleneck in haulage right now, and that's reported to be capable of being kind of doubled month on month effectively. That's ambitious, but it's also like if they're providing guidance and confidence to it, that's what I think is really driving the market sentiment today, and part of the reason why the share price I think has responded so strongly and is back in the 20s is some belief that this might be possible. I think that the challenge is still going to be for them to do it. I don't think it's any mean feat to just kind of double your haulage month on month. And keep in mind that they are, of course, they're doing upgrades on the road. The more of their own trains that they add to that road, the more productivity they get out of those trains, the more that's going to inhibit the kind of the traffic flow management that they've got. So those two things are kind of going to be working against each other. And then on the contractor trucks, they're also adding pretty significant volumes of them, and of course they can't carry as much of a payload. So the frequency that those contractor trucks are using the highway is pretty frequent as well. Meanwhile, relying on the access road pretty heavily. So
because the speeds have come down as well.
The speeds is an interesting point, right? Because the contractor trucks can run at different speeds to the jumbo trucks. That's
they tend to be smaller.
They're smaller
So,
and go faster, and I think that's why they're now operating on effectively separate routes, because your contractor trucks were who are getting stuck behind jumbos, presumably. And if you're stuck behind a jumbo that's going slower because it's got a bigger payload and it can't get up to speed as fast, then that's a big issue for your contractors who are getting paid per ton they're moving, but they're limited by how fast they can go because they're stuck behind the jumbo. So now all of a sudden there's separate routes and potentially a path forward, albeit it requires considerable scaling of contractor trucks.
Yeah, and that sort of spoke to breaking up the repairs or really the redo of the road in parts, and I think the market took a bit of liking that one of the smaller stages is already notched off, that progress is really being made on that. But if we look now at mining services, because mining services again relates because a lot of the tons come from Onslow tons, and you've got changes in EBITDA from half one to half two is quite anticipated as management had sort of outlined. What's the latest thinking there?
I think this is a really big point. The mining services business is there's a perception this is the backbone of MinRes, and it's infrastructure like income, long life contracts, margins just keep expanding over time. But what we've seen in the quarterly today, I think challenges that assumption. Now, what MinRes recorded for their earnings when they came out for the first half of this financial year, they said their EBITDA per ton in the mining services business was $2.60 per ton, and that was record EBITDA. Big charts going up and to the right. Of them doing more tons and getting more out of it. Now,
to their credit, they didn't want to pin the market's hopes on that, and they said even at the call at the time that don't put that in your model going forward, which they really emphasised again today.
I don't know if the market was prepared for what eventuated today, because MinRes is forecasting FY25 mining services EBITDA to be just $2.20 per tonne now. That's for the full financial year 25. So forecast tonnes for the second half isn't changing that much. For EBITDA per tonne to come down to $2.20, that means the second half EBITDA per tonne will be $1.60 thereabouts. That's a massive erosion of margin in the mining services business. $2.60 to $1.60 in a half year. Annualize that $1 per tonne is like $260 million of EBITDA from the mining services business, kind of gone from what might have been in some people's heads. And why? Well, it's the mining services business that has to wear the cost of the third party trucking at Onslow. This is I think this is kind of an interesting point, right? Because the Mineco itself, the economics to the Mineco, which MinRes has JV partners, well, they're paying like a predetermined rate for the haulage. However, MinRes is on the hook to contract out the cost of the third parties to actually conduct haulage, where it's clearly had some limitations, and that has to come out of something, and it's certainly hitting the earnings of the mining services business for the time being.
Yeah, it really speaks to your point of looking at cash at a group level for a company of this sort of nature and putting it all into context while you do the work on each individual bucket here. In certain aspects, Peter's going to be paying Paul and vice versa. So you want to make sure the company's making money at a group level.
Well, that's like, I think that's the point to kind of dwell on a bit. Like, I'm trying to get a grasp of the economics of Mineco, and you can sort of infer that by what happens to the carry loan. So the carry loan, like the way that this carry loan works out, is MinRes is kind of entitled to priority free cash flow out of Mineco when it's sort of free cash flow positive. And that
for people just quickly wondering, that's money that Mineco sort of sits there that is owed to MinRes from its JV partners.
Correct. And that didn't really move too much. It kind of got paid down, sort of. I think it was like single digit.
Yeah, it went down $5 million.
$5 million bucks. So, what that tells me is that Mineco is kind of still washing its face at current volumes. It needs more volumes to actually generate free cash flow out of Mineco when you really factor in kind of all of the cash flows there. And that's, keep in mind, not factoring in the cost of contractor, trucking, because MinRes is wearing that separately, 100% sort of MinRes. Mineco is only paying the predetermined mining services rate on the haulage on that front. So, I find that kind of interesting to start with. The other thing that's kind of interesting when you think of like Mineco economics is MinRes still hasn't declared commercial production on on Onslow yet, and that's an accounting thing. Once you do declare commercial production, all of a sudden, you can't capitalize OPEX. The extent they're doing that's still kind of unknown entirely in my mind. So I just find all of that kind of interesting. But that's why I always just think like you really want to look at group level change in cash to really get a snapshot of the health of the business at a point in time.
Yeah, and to be in MinRes's corner for a second, you wouldn't expect them at a run rate of 15 million tonnes per annum when they call it 35 million being nameplate to have called commercial production just yet.
Yeah, well, sometimes you call commercial production as soon as you start to get sustainable free cash flow. But yeah,
I know a bit different to other sort of products and stuff, but there's, like you sort of mentioned, ramifications of calling commercial production. So
totally, and sometimes you kind of have to call it even when you're not profitable. I mean, like Linus finally declared commercial production at their Kalgoorlie facility, but yeah, show me the positive operating cash from that, and I'll give you a Freddo frog for free.
One day. What about Ken's Law, just quickly?
I want to do some more work here. I found it intriguing that MinRes there's three things that are intriguing to me about the actual mine gate. So Ken's Bore we all know was where they where the whole road goes, where the camp is, where they're bringing online initial volumes from.
It's a resort.
Yes. Now what they've been doing is rapidly advancing two other areas of their of the project, being I think it's Cardo Bore East and Upper Cane. Now those are kind of like 15 kilometres ish away from Ken's Bore, so there's more kind of logistics to get it to the whole road and all that sort of stuff. But it's those are smaller deposits, so you don't have as much kind of economies of scale. But they do have slightly higher grade and slightly lower impurities. And what MinRes talk about is the ability to kind of blend it all and all that sort of stuff. And Ken's Bore becomes the central hub where you can do all of that. I find it intriguing. I really want to dig into this a bit more because I find it a bit a bit suspicious that that maybe they're was this always the mine plan to bring these areas on as fast as they are, or is this kind of like a strategy in order to really maximize the cash flow potential of your early product because it's got the better grade and the lower impurities, but there are longer term ramifications, or is there also a statement about the quantity of material that is actually suitable at decent enough realizations at Ken's Bore itself, which had a pretty big step up in its own strip ratio in the quarter. I just need to do more work here. Is the gist of what I'm saying. I don't have the answers. I'm just curious.
Probably goes back to not actually 2 years ago seeing a full study come out on the project, right? That it's harder to reconcile, but obviously it's in their interest to pull down payback and all those sorts of things.
Yeah,
not at the forsake of the long-term life of the mine, but
exactly. And there was the leaked technical report that the Fin talked about, which spoke to the fact that that some of the material at Ken's Bore has a lot of these gang material and clays and a wash plant for part of it. Now that might be true below the water table, or it might be true for some in the stuff that they're mining at the moment. I don't know, right? But if you've got a portion of material and you're selectively kind of stockpiling it, and then you're kind of the stuff that's got less clays and it's got better realizations, and you're being quite selective about what you're putting on the whole road, then I could understand that. But I do think that that's kind of a part of the economics that typical analyst isn't really thinking about the implications of too. So I just need to do more work here. If people have answers or insight, please reach out to me, travis@moneymind.com. I'd love to know.
All right, let's talk a bit about the lithium business just quickly to bookend this one.
So the lithium business, the reported cost improvements in the lithium business certainly stand out on paper. They're so remarkable. It's tricky to plausibly believe in their entirety. To the extent these cost savings are have been legitimately realised from the savings in headcount, reductions in various areas kudos. Yeah, take Wodgina. So this quarter they shipped 12% less product than last quarter. They moved 4% more material than last quarter. The grade was 7% lower than last quarter. And yet somehow the unit costs were lower, 23% lower at $775 $5 per ton SE6. I just can't reconcile where that cost saving has come from. I mean, that can't all be recoveries. Like, yeah, it's just really, really fascinating. It's just a question mark that how they get that one. So, yeah.
Yeah, and I think, digging into the detail there, costs had been overshooting guidance year to date so far before this one, but they hadn't gotten rid of that guidance. So they were expecting improvement, and then they factored in cuts in costs.
But how do you get the physicals to match the unit costs there? When I don't know, just
I would think there's a lot of
lots of accounting tricks.
a lot of accounting and pretty much everything that doesn't need to be spent, which again talks to the long term treatment of the asset being cut for the sake of near term survival.
Yeah, but
I think there's a few levers on that front to be pulled.
There are. So I just think it's worth kind of wrapping up with our thoughts of where where we think the business is at right now. JD, what are your thoughts, kind of having listened to the call yourself?
I think they've really addressed some of the concerns or played into what they thought the market wanted, which is what it did, which is the reason why it's jumped up so substantially. They haven't alleviated a lot of those concerns. They've just given more colour as to how they're going to do that, mainly on the road. It's the sort of be all and end all, So there is still the execution risk. They still need to get up to that 35 million tonne per annum run rate for all the reasons we outlined when we spoke about them a couple months ago. So, yeah, kudos to them for giving the market what it kind of wanted on that front, but it's still, execution on that front. And that debt pile is getting closer by the day. And yeah, we know what a refinancing kind of looks like on that front. What about you? What do you think?
I think I echo your sentiment entirely. I think the execution, so it's like what they've got to do in May and June is effectively double the haulage throughput, where they've got real constraints on the road, and it's not going to be like when you're kind of just doubling that, it's not going to be fully known what the risks are of doing that until you do it, and then you're putting pressures on certain areas along the way. So whether they can do it or not, like I don't know if it's possible. If they can, yeah, kind of double the throughput on the road while half the road is offline, I think that's a tremendous win. And I think like the short term is rosy if they can do that. But it's a big if. It's a big if, right? Because yeah, like there's a lot of stuff that can still go wrong. And then I think on the longer term horizon, the way I interpret like what's going on with the actual road and the repairs on the road and everything like that. So there's like the asphalting, there's the cement and foam fill. Now that's going to give the road sort of rigidity repair for certainly the short term. And while the months are colder, you would actually expect it to certainly be more durable. It's going to be like the January, February where pressure is going to come to that road, and that's when I think we'll know if the repairs have been sufficient or not, or if there are further fundamental issues that come about with the road. At the moment, the road's forecast to be upgraded by September. Like they could have some phenomenal like performance on that road from the month of September to December while the month is still cool enough to not put that road under too much pressure. If they're also restricting the payload of the trucks to 260, if they up that to 330, it's a very big difference because your road damage scales exponentially with the load.
It's got to be built to last that debt balance, right?
And the debt like so cash went down 250 this quarter. I don't know if all of the interest repayments on all of their bonds were actually kind of payable in this quarter. They might have actually been a second quarter thing this half. So
yeah, semi-annual payments.
It's not to be understated, like the impact that $400 million of interest payments alone can have. The good news is that there's like this quarter could have been a lot worse as well. Like $250 million cash bleed. This could have been they could have lost. Cash could have gone down by $200 million more than that this quarter, and that wouldn't have been a massive surprise. So I do look at it in the context of like things could have been much worse. Cash is still going down. That's not good. They've painted a picture where it looks like next quarter could be positive cash flow if everything kind of goes right, and that'll be a big turning point.
Yeah.
But I don't think that's a sure thing at all. In fact, I think it could very much go either way on that front.
Yeah, and of course we had the revisions just halfway through the quarter. We were revised on guidance and these sorts of things, so weren't coming totally out of the blue into this quarter.
Yeah, and overlaying all of that is just the commodity backdrop. Like when you're very leveraged, you're also just super susceptible to changes in commodity prices. That can be a wonderful thing or a dreadful thing. So there's just vulnerability still. It's kind of keep on chipping away at it though, and as you're chipping away at it, and as you're doing your earthworks on the road and everything like that, you kind of need some yellow gear, JD, when you're doing earthworks.
Who do you think of when you think of yellow gear, mate?
I need people, I need kit, I need equipment that can help me with my civils, and that is KCA Site Services, JD. Just call KCA.
Equipment, recruiting services, KCA. You just got to hammer those ones together, because if you need either of those, equipment or recruiting services, just call KCA.
Mate, here's some of the equipment they've got for hire right now in MinRes. Call them. 4 12-seater Toyota Hiace 4x4 mine spec buses, Mitsubishi Fuso tipper truck, Volvo 5T 5-ton excavator. You've got 2 brand new ITs. If you need anything from ITs to surface trucks to LVs to excavators to graders, call KCA. Just call KCA. And if you need people, they've got service crew, charge up, bogger operators, underground shift supervisors, mobile crusher operators, open pit all-rounders, underground HD fitters on all sorts of different rosters. KCA, the name to remember for all your recruitment and equipment hire needs.
Go KCA Site Services.
Now, Jonas, JD, Jonas Benedict, JBD. I'm really interested in what's going on with Emerald. I've got to admit, Emerald, we know they produce gold from Cambodia, but my knowledge is it's not as elaborate as it would be for some of the other ASX listed kind of more domestic producers. But I'm very curious in the fact that they've had a big drop down in what they actually produced this quarter versus last. What's going on?
Yeah, there's a number of reasons to be interested in Emerald. I'm sort of attracted to them because they're a bit quirkier in the sense that they're not just your run-of-the-mill goldfields, mid-size or mid-cap goldie here. They operate in a bit more of a colourful jurisdiction in Cambodia. And they're also one of those companies that have been a long-time performer now since they got Okval up and running. So they've got the quote-unquote management premium attached to them. And they've got a lot of growth factored into the story. You might be paying for that already. So I think for those reasons, I was keen to get into what this company is looking like today, what it could look like in a couple of years, and to really kind of dig into why they had that downgrade on March quarter production, as you mentioned first up.
Well, tell me, mate, why did they miss?
Yeah, so to put the miss in context, they did about 19,000 ounces this quarter at a bit over 1,300 US all-in sustaining cost. Now, the quarter before that, they'd done 32,000 at 850. So that's a pretty big drop-off, and as you suspect, the unit costs commensurately jumped up quite substantially. So putting the miss into context, why it's kind of happened, I think it was a little while in the making. They don't spell it out. They give you kind of 3 dot points when they pre-flagged this a month ago. Now, cutback activities at the operation in Cambodia limited access to ore. And they didn't say this specifically, but I suspect this kind of stems back to an announcement from September last year where there was a bit of a pit wall slip. That saw them do these cutback activities a bit earlier. So they would have been doing these otherwise. It was, all planned out already. It just spurred them on to do it a bit sooner. Now, that unfortunately led to limited access to other parts. And that leads to the second challenge that they had, where the areas that they did have access to didn't reconcile well with the reserve grade. Now, that's a big problem. It's the first time we've sort of seen a problem of this nature at Okval. Like, I'm sure they've had it in sort of parts, but they've been able to compensate throughout the quarters by going to other areas. But given they had limited access to the other areas of the pit, they were stuck with this one, and hence they were able to guard the market in March already that, hey, this wasn't going to be a good quarter, because they knew they couldn't do an awful lot.
So there's 2 issues there. One is, reduced access to good areas, and the other one is reconciliation. It's the reconciliation that would worry me much more as a shareholder, because you worry about a potential for that trend to be expanded for life of mine or for a period of time.
Yeah, 100%. It's a real cause for concern. It's something you really want to dig into, and the company understands this fully and tries to alleviate all the concerns of the shareholders. So I'll just read out the line that they said to describe this quickly. The forward-looking grade control indicates that the uncharacteristic underperformance of the reserve in the areas accessed this quarter is an anomaly and not a trend, specific to like the point that you mentioned there. You don't want this to be a trend. You want it to be a one-off. And yeah, they reiterate further on that the cutback limited their ability to mitigate underperformance. And I'd be lying. I'd be talking out of my ass if I could say whether this is going to be a problem down the track. I think that's a challenge that a geologist could sort of dig into. But even so, you've got limited information standing outside the walls of the company. So it's just something you're going to have to scrutinize quite a bit in many of the quarters to come. And the company gave pretty specific guidance quarter by quarter going forward, as well as through FY26 to really address these challenges. And to just spell it out a bit more, if you look at the physicals table here, you can see a head grade of 1.2 grams per tonne in the quarter. If we go back the past 3 quarters, we're talking about 2 grams per tonne, about 1.8 and about 2.1 grams. So that's a big drop off, and that puts into context the challenge that they faced over this quarter. On the positive side, they put a lot of work into improving recoveries, and they're sort of bearing the fruit of that. So if you look at the recoveries line there, you can see 85.6% for a quote unquote refractory ore body is not too bad, and it's been improving quarter by quarter.
Especially as grades coming off for recovery to go up is impressive.
Exactly. So that's a real positive that shouldn't be missed, because the benefits of working on your recoveries as they have been in that sort of way is it's a really positive thing, and hopefully they can keep them up there, as I'm sure they will, because they did invest the capital needed to unlock that. So
I did look at the like cash actually went backwards for Emerald. I mean, they did have some big one-offs, but it was surprising to see such a, I think they're almost the lowest cost producer historically of the producers on the ASX in some quarters to actually have cash balance go backwards was very surprising to see.
Yeah. Let's talk about cash. So to your point on lowest cost producer, even next year they are flagging guidance all-in sustaining costs to be under $1,000 an ounce. So that is pretty competitive. If we look at cash, 210 million cash and bullion is what they closed this quarter at, and they were about 243 million where they ended the year at. So the big one-offs is the 50 million plus in tax that was for FY24. That's a big one-off that they had to wear this period. But on the positive side for the cash, they actually sold 5,000 ounces more than they produced over the last quarter. So yeah, ebbs and flows. That's a positive. But
they've got a growth project in Western Australia from the acquisition of Bullseye. Where is that at?
Yeah, let's talk about the growth projects. This is pretty exciting for the company. So camp installation is happening. This is north of Laverton, for those wondering, and we'll flash up a map so you can get a feel for it. But 6 million was invested in the asset over the last quarter on, development, not an awful lot on development and on the feasibility studies, but there's been a bit of a hold up here. So you got a project with 1 million ounces at a bit over 1.1 grams per tonne. Now, if you go back to the annual report, which came out mid-2024, it was planned for the DFS to already be out. This was meant to come out before year end in the December quarter. That didn't happen. So they spoke about some of the work they were focusing on. That's resource definition, which did happen. We had that updated mineral resource come out in the December quarter. And the second point was that they were working on the completion of environmental assessments, which leads into permitting. And I would suspect that's been the holdup. They didn't say explicitly what has held them up, but given everything going on across Australia, in WA, look at Mount Gibson and other sort of similar projects, permitting has been the holdup. It continues to be the holdup. And I think for those sorts of reasons, the company doesn't want to put the cart before the horse. They don't want to talk too much about it. They just rather keep doing the work that's within their within their sort of grasp, the things they can do, and wait, because there's been a lot of changes on this front, and it's really not in the hands of the company, is it? I mean, we've spoken about it at length over the past 6 to 12 months.
Yeah, I think you let permitting, like to the extent permitting pushes back timelines, you let that be like a slow release of expectations to, constantly be pushed back rather than all at once.
Yeah, nevertheless, they still did say that they expect to make FID and commence developing this year. And
Right.
there's a bunch of tenements. Like if you look on the map we flashed up before, the chart on the left, that's a 90-kilometre long sort of area where they've got tenements adjoining. And then the chart on the right is a sort of zoomed in area of the yellowy sort of spots there. So they have mining licenses that were granted in 2021 on a number of those areas. Other ones are, as you can see, exploration licenses and whatnot. But I think it's a bit out of their hands. You can't build a project with kind of half the permits you need it all to kind of be in place. So
they call this project Dingo Range. What kind of production profile are they expecting from it?
they don't give you too much colour on this, but what they do say is they want to be a 300,000 ounce per annum producer with many operations. So I'll speak to Mehmet, which is another growth project in Cambodia in a moment. But given the 1 million ounce, the 1.1 grams per tonne style of this ore body, I would sort of benchmark it to 100,000 ounce per annum with a 10-year mine life to kind of start. I'm sure other people have more kind of specific numbers on it, but I think it's a rough kind of rule of thumb that you could use. And yeah, I'll talk in a moment actually about what costs could kind of look like for this, because it's interesting to look at the cash position and tie it all in together. If we look at Mehmet for a second, this is similar again, 1 million ounces, 1.65 grams per tonne, so slightly better grade than Dingo. Very similar stage. Feasibility studies are underway. They're looking to permit and do all these sorts of things. Very similar spend over the quarter. If we look at kind of what CapEx could look like here, given I think this is a similar scale to Okval and even to Dingo Range, I think we're all in that sort of 100,000 ounces plus or minus area. Okval cost about 150 million Aussie to build, 2 million tonne per annum plant. That was 6-7 years ago when the DFS came out. So we've seen cost inflation since then.
Yep.
That size plant would see Mehmet do about 90,000 ounces. So I think it has to be slightly bigger. It would be a very similar processing plant. Recoveries are 85% plus is what they call it. So I would sort of suspect Aussie 200 million plus if they're going to build something similar. And to go back to what Dingo could kind of look like, I think Mount Gibson is a good proxy for that one. Now, Capricorn, we know they raised late last year. They had initially about $260 million earmarked for Mount Gibson, similarly been held up on a permitting front. But I think just to keep things fairly simple, benchmark it in and around that same kind of cost, 250-ish million. I mean, Capricorn have a great reputation for getting stuff done, time on budget, obviously when it's in their hands. Emerald with Okval, again, that's a similar sort of reputation. They got it delivered and exceeded a lot of people's expectations. So I think you're feasibly looking at $400 to $500 million. I know I saw just one other estimate out there, hard to come across info, but people were putting it a bit under 400 million. I'd be surprised if your total capex for both of these projects comes in under 400 million, but who's to say? So you've got a company which by mid-year could have 250 million, and I think Okval could deliver them another $250 million over FY26. A lot of numbers here, but you're working out back of the envelope, potentially a bit of a funding gap. So it brings about the question, how do you address that?
Well, that's a funding gap if they were so ambitious as to build two mines simultaneously. I think in reality, you rarely ever see that.
Exactly. I think what you do is you kind of offset them, which is kind of interesting if you dig into the details to see that they've lined them up. They want to start development, both of them this year. You would have thought perhaps they stage them already and just plant expectations nice and early that they're on a stage them, but that's not what they've done to date. Maybe they'll do that in future, but for a whole range of reasons. They don't have any debt right now. They've paid off the last bit just recently, but Yeah. Do they look at signing up a bit more debt just to see them through that period? They're valued fairly strongly. There's growth built into the share price as it stands right now. You know, I said maybe doing $250 million in cash flow for a company that's capped at $2.6 billion.
Yeah. $2.6 billion and all of its production day from Cambodia, two-thirds into the future once all growth is online, still in Cambodia just always kind of question marks on that, you know, given Cambodia is not Western Australia. But
yeah. 5 to 10% dilution would not be the end of the world by any means. It would give them a big pile of cash to just go at this. Again, I still think they'd likely stage them to an extent. I think permitting will do that for them potentially. So it'll be interesting to see which route they go down. We've spoken at length about the risks of pulling in debt, and it's particularly when things are rosy and things are good. Paladin comes to mind last year when uranium prices flying. They're starting to work through the stockpiles of the previously mined product there, and then you sign up the debt. So it's always when times are really good that people look, hey, we can lever up the balance sheet a little bit. So I'd be curious to see what they do. I think they can work through it, but that's what you always kind of think, right? Until you can't.
Yeah. The good news is if they were so ambitious as to build both at once, they're still probably not going to need a ton of debt given gold prices, operating cash flow, and all that sort of stuff. It would be tricky to find to think in your head that they would get debt that would be onerous to the company. And furthermore, they wouldn't need to get project finance either because they have diversified assets. They'd have a corporate facility, far less restrictive, and a lot more flexibility to navigate some of the things that can be, you know, pitfalls for single asset developers.
Yeah, that can't be understated enough. Debt can be super, super onerous if you've got your one project that you're trying to get into production. The more you produce, the more cash you produce, the more assets you have, the terms become more and more favourable to you. So
one thing I do wonder with Emerald is like if they were, I wonder how motivated they are to diversify their geographical risk, and clearly that's been a motivation for them to enter Australia via Dingo Range. And like I think when Okvau was their only asset, they were certainly pretty hungry for something in Australia, and they got a pretty interesting and good deal away to get that growth project. I do wonder if they'll increasingly look to diversify that geographical risk, be it by buying, you know, more assets. We've talked in the past about what's for sale in Laverton, and like can you actually do something that's synergistic when you group that together with Dingo Range. Plus, the other option that they could have is actually just merging with one of the many mid-tier gold producers that we have with Australian domestic production but no growth. If you merge with them, they suddenly get growth. I just think there's probably a bid-ask spread, and everyone's got to get comfortable with that. But if the motivations are high enough, I think that's also a possibility that, you know, probably can't be discounted as well.
Yeah, absolutely. For the same reasons we spoke about the capital raise, potential capital raise just a moment ago, doing a deal could be favourable. You know, they'd argue the opposite, saying they're coming into growth and all this sort of stuff. But yeah, given where they are, I'm sure they'd be looking at their options.
Very interesting, mate.
I think that's a good spot to leave it, mate, as we come into our last day of quarterlies tomorrow.
I can't wait for them to be over, and I similarly am just very thankful to all our partners.
Yeah, let's run through it. JRX, get your tickets to the conference, the Mining Innovation Conference you need to get tickets to, May 20 to May 22nd in Brisbane. And a big thank you to Mineral Mining Services, Grounded, Sandvik Ground Support, CRA Insurance, K-Drill, WA Waterbores, Quattro Project Engineering, KCA Site Services, Black Diamond Drilling Services, and Cross Boundary Energy. Hootaroo.
Hootaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.